All right, everyone. Thank you so much for joining today's weekly Zoom trainings here at First Team Real Estate. We appreciate you being part of today training, being part of the company as well. We have Justin, here, and going to cover the 1031, exchanges, too, and what does it mean, and going to dive deeper into it so we understand the benefits of a 1031 exchange and the tax break there. Justin Evans, spoke with us before. He's outstanding at what he does. Justin, take care. You're on.
Thank you, Greg. And hello, everyone. I don't know, I've probably met half of you guys, I'm sure, before, in the trainings that we've done a couple of years ago. So good to see everyone again, and to everyone else, nice to meet you, and thank you for having me. I'm going to go ahead and present my screen. Give me 1 second. Okay, can everybody see that okay?
Yes, we're good.
Okay, awesome. I got to move this little presenter thing and I'll be good. Okay, awesome. So this presentation, for anyone who's seen me speak before, it's going to be somewhat familiar. I reuse some of the slides, but I've added some stuff in there that I found to be useful in the last, I don't think I've done a training with you guys in 6 to 12 months or something. So I've added some new stuff too. But this is me on the left with a shorter haircut. And with me today, I have Aaron Cancevicius. He is our lending director. We do a couple of loans in-house in addition to being a 1031 exchange accommodator, really only just to do, to help specifically with certain 1031 situations. But anyway, he's not going to be speaking, but he is here listening in with us. We did change the name of our company too. We just, as a general proviso to everybody, you'll see on the right there. If you'll remember, we used to go by selltaxfree.com. We had some investors come into the business and kind of rebranded the company a bit to Plenty Financial. So just wanted to be upfront about that too, so it's not confusing, but we're still doing the same thing. We do 1031 exchange accommodation. That's the primary business, and consult with investors every day on how 1031 can save them money. So let's see here. So today we'll be talking to you about how the 1031 exchange can help you as a real estate agent get sell and buy side leads. 1031 has been a really interesting point the last couple of years, just because how high prices have been and are kind of still at that price point. And then moving into next year, I think everyone's kind of anticipating it may become a bit more of a buyer's market, which can still be really, really friendly for 1031 as well. But either way, as I'll show you guys here, knowing what the exchange is, especially as California real estate agents, is extremely beneficial to your clients, just because the tax bills here can be so high. So we'll show you how it can help you get sell and buy side leads, repeat and referral business, and really just do a big favor and look awesome to your
Justin. Can they see Justin's screen? You're sharing it. Doesn't seem like it's been sharing. Can anybody see his screen?
Yes, Greg.
Yes. You can see it?
Yes. I can see it, Greg.
Yes. Okay, just wanted to make sure because some people were saying they can't. Okay, great.
Thank you. Yeah, thank you. Okay. So let me see here. So first of all, just the general rules of what the exchange is. There are a couple different ways you can do it, and I'll go through those later in the presentation. But generally speaking, what the exchange is a tax break from the IRS that allows you to avoid paying capital gains taxes that would otherwise be associated with your sale if you reinvest into new real estate. The general rules around this, as you'll see on the screen here, are that if you want to pay no tax, the IRS wants to see that you reinvest all the cash equity coming out of your sale into a new property or multiple properties, that's fine too. And that the value of the new properties that you buy is at least its same or greater value as the property that you sold. So you'll see in the example here, you're selling for $450,000. Let's say you have a $200,000 loan to pay off. And title and escrow costs. So you have $200,000 in actual cash equity. Again, the main requirement of the exchange would be reinvest the 200,000 and use it to purchase new property worth at least 450,000, the same value as the property that you sold. The other main thing to be aware of with 1031 is the timeline. So as you'll see here, 1031 has to be set up while the property is in escrow. And again, you can do the exchange multiple different ways, as I'll talk through later, but the one I'm showing on the screen here is a standard exchange. That's the most common way 1031 is done. So that's where you're selling your property first and then purchasing the new property second. So in this case, the exchange gets set up while the property is in escrow. So once the client has accepted an offer, we'll set up the documents. That's really what we do, is set those documents up. And then when the sale closes, that can be thought of as day zero. And that's really when the clock starts ticking. You'll see here the 45-day and 180-day deadlines. So 45 days only from the closing date of the sale to identify the new properties to us. And we give the client a list. Everyone always asks what identification really means. We give the clients a list in their exchange agreement that they set up with us while they're in escrow. And they can list up to 3 properties of any value there on that form. And there are ways to list more than those 3 properties too, but the IRS starts imposing a lot of other rules on you, if you go above the 3 property limit. So most clients just stick to 3. And then in total, they have 180 days, again, from the closing date of the sale to actually complete the purchase of any of the properties that were identified on that 45-day identification letter. They do have to buy something that is listed on that form, though. If they were to get audited and the IRS saw that they bought something that was not on that form, they would be liable to pay the taxes. The exchange would likely fail in the event of an audit. But that's basically it for the overview of kind of what the reinvestment requirements and the timeline are. Let's see here. So I go into next really why the exchange is applicable. Why is it so beneficial if you're in California? Obviously, property here goes up in value all the time. We've certainly seen that over the last 2 years in particular. When a piece of real estate is sold here, the total tax bill that clients are looking at as California residents is 30 to 40% of the profit. Another thing, you guys do a lot of business in Orange County and Los Angeles. I did see recently that ballot measure, I'm sure some of you saw, that the city of Los Angeles passed too. There's going to be a tax, I believe it's being classified as a capital gains tax at the city level, I think, of Los Angeles. I don't think it's LA County. I think it's just the city, but it's for any kind of commercial transactions. I don't think it'll apply for residential. But the reason I wanted to bring it up is because I think it's on any properties over $5 million, the city's charging a 4% tax. And on any properties, commercial properties, again, over $10 million, they're charging a 5.5% tax. So this number on the screen here could even go up, just kind of depending on the locality that you're working in. And obviously that LA tax, like I said, is only subject to commercial property. But still, this number can be pretty big. And I'll break down this one usually surprises people. And this is one of the slides I've added, is to kind of take you through what those always just assumes that the federal tax is the tax being charged, but there is a state capital gains tax too. And you guessed it, California has the highest state capital gains tax in the nation. So at the federal level, you're typically paying 15 to 20% of your profit. It just depends on the amount of profit you have. I believe this 20% figure does not start coming into play unless you have over, I think the number is 400,000. I'm a little rusty on what that threshold is, but it's something right around there. Most people will be in the 15% zone. Net investment income tax is another one that's charged on any profit over $250,000. Then depreciation recapture tax, if the client has used this thing as a rental property and they've been claiming depreciation on their tax return to write off against their income. They also get taxed on that benefit that they were given, during the time that they owned and were using the property as a rental. They're taxed on the way out. 25% of the depreciated amount is typically the calculation. And then again, the state of California, this is the important one that I think people always overlook. 13.3% is the state capital gains tax. as well. So in total, all things considered, you end up pretty typically with a 30 to 40% figure. And again, that could even go up for commercial properties in Los Angeles now. But the exchange allows you to get out of all of these. If you complete the exchange in full, you can avoid all of these taxes, just to be clear. So just to put that in real world dollar figures, if you have a couple here that has $200,000 in profit on a piece of property that they're selling, they're typically going to be looking at taxes of $60,000 to $80,000. So really solid chunk of change. And just one more example, just to put it in real world dollars. You have someone with $350,000 of profit. And we see these numbers all the time, in California. Someone's going to be looking at $105,000 to $140,000 in taxes. So really, really substantial chunk of money that they could keep in their pockets. It's another thing about 1031 I don't think that people understand often enough is when you do the exchange, as long as you continue to exchange really forever, and then you pass away, the taxes never have to be paid. So this can be, the kid in this example kind of reminded me of this. This can end up being inheritance for kids and everything. They're not stuck paying the taxes or anything like that. It's just a matter of being smart with the asset throughout the kind of life cycle of it, and never really never breaking the chain without using an exchange and just selling the property outright, because that obviously would trigger the taxes. But anyway, yeah, just wanted to put that in real dollars. The other thing, and this is a new slide too, that I did want to touch on quickly. I get the question a lot about the tax break for a primary residence. Now, this slide, to be clear, does not have to do with the 1031 exchange, generally speaking. 1031 is applicable on investment properties. We'll get into that in a few minutes. This tax break, the one I'm sure you're all familiar with, you all work with homeowners, the $250,000 and $500,000 exclusions, those are really just for primary residence properties. They are not for 1031 exchange properties, but I did want to go through it briefly. The qualification there is if you've lived in the property 2 of the previous 5 years. They do not have to be consecutive years. You'll see here, I colored these dots kind of differently. Any 2 of the last 5 years would work. So either of these combinations and any other combination you come up with would be fine, as long as you've been living there and filed that as your primary residence on your tax return. If you're single, that equates to $250,000 of profit that you can take off the table tax-free. And if you're married, that's $500,000 of profit that you can take off the table tax-free. Any additional profit past that, just because again, California, we do see these numbers exceed this a lot, that would be taxed at the rates that I showed you on the previous screen. Unless 1031 is somehow applicable as well. But anyway, again, this is outside of 1031. I just always get the question as we're talking about taxes, so I wanted to go through that really quickly too. As far as the 1031 exchange go, this is if the property is used as a rental. You can see on the top of the screen here, clients save a ton of money that again, they would otherwise pay 30, 40% in tax. And whoever brings it up, you, me, or anyone, really looks awesome because the numbers, as I showed you before, can be really, really substantial. And again, on the real estate side, if you have a seller where a 1031 is applicable, that they're required to buy a new property within a time frame. And anytime I talk to real estate agents, I point that out. It's everyone's dream client. You have someone who's selling a piece of property and has to buy something of same or greater value within the next 180 days, about 6 months. I think that's that's everybody's dream. So whether or not it's someone in your market or not, just to even have the opportunity, it's a really great lead for any real estate professional as well. The problem really is that a lot of times agents and their clients are not familiar with all the different property types that qualify for 1031. So that's what we're going to go through here. And you'll see on the left side of the screen here, you'll see a lot of property types that probably are familiar with kind of the classic 1031 qualification. So this is your single family rental properties are always going to qualify, multifamily rentals, your duplexes, triplexes, 4-unit properties, Airbnb and VRBO rentals, this is still a pretty new one. Obviously that's been going on as a service for a while, but in terms of its application to 1031, that's still a relatively new applicability there. There are some usage requirements around that. You can't rent the Airbnb for like one day of the year and then say it's investment property. But generally speaking, if you have any sort of a consistent use, that would qualify as well. Vacant property can also qualify for 1031. Vacant property, the IRS considers a bad investment because it's not generating income for you. But the key word there is investment. They do still classify it as an investment property. So those can qualify as well. And then commercial real estate always is going to qualify for 1031, any piece of commercial property. That's the really classic use of the exchange. And on the right side of the screen, you'll see some that are lesser known. Second homes and vacation properties can qualify for 1031. Those have usage requirements too. The IRS really does not want to see that you have been using it personally more than 2 weeks per year in the year or so before, year or two before selling the property. But it's not that you can't use it at all. It's just that they kind of place those limitations on you to signify that it's an investment property rather than a property you're using for personal use. But those can qualify if those qualifications are met. And then I always pause here too. Again, generally speaking, the 1031 exchange does not apply on primary residence properties. The only times really that it would is if you have like a duplex or a triplex or something, and you live in one of the units. In that instance, you can actually combine the two tax breaks. You'd be able to combine the primary residence tax break we went through before, the $250,000 or $500,000 exclusions, and the 1031 exchange. But generally speaking, they don't typically mix. The only other two instances where they would is if the primary residence had like a home office or a workspace, if there's some kind of a shed or garage space, or maybe you've been Airbnb-ing out a room or something like that, that can qualify for 1031. And that can be really helpful for, again, we just see it so much in Southern California, properties that have gone up a really considerable amount, somebody who bought in 1980 for $40,000, $50,000 and can sell now for 1.2 million, that $500,000 exclusion is not going to cover the whole tax bill. Obviously, there's a lot more profit there. And so something like this is another great way to kind of shelter additional profit on top of that amount. And the last one here is primary residences that have been involved in a divorce. This one does not come up that much. But you guys know, I'm sure on the real estate side, divorce is often a trigger for the sale of property. But if whoever the party is that moved out of the property and has established a new primary residence, their 50% interest in their former property that they were, married, living in together, is now considered investment property. So they can potentially exchange that too when it does come time to sell it. So that's kind of the general list. That's everything. And then you can also go into and out of any of these different combinations of properties. Generally speaking, you can sell a single family rental, you can get into a second home or vacation home, and vice versa. You can sell an Airbnb or VRBO property and get into single family property, and vice versa. You can sell a piece of commercial real estate and buy a second home or vacation home, and vice versa. So these are really powerful combinations to know about. I get the question so much. It's known, I think, historically that 1031 is as the like-kind exchange. And people think that like-kind really is just referring to the very specific asset class that's being sold. So if I sell a single family rental, I have to buy a new single family rental, and that's not the case. So a lot more opportunities open up, especially if you have some clients who are interested in buying a vacation home, but they own some other real estate. Something like this could be a really great option to kind of get them out of the rental property that they're looking to sell and get something that they can use some of the year. And potentially, if it's down the road a little ways, they can potentially even end up moving into it. So anyway, these combinations can be really useful as well. We just, again, find time and again, a lot of clients and a lot of agents too just are not familiar with 1031, since it doesn't come up every day. So I was going to take you through another couple examples just to kind of solidify the math here. I see it all the time with the exchange that I think a lot of people get confused and think that you just have to reinvest the profit or you just have to reinvest the equity. These are really common misconceptions with 1031, and they are false. So, you know, I joke with people. It's like, I feel like half my job sometimes is kind of clearing out the crap that people read on the internet before coming and speaking to me. So just to go through kind of what the actual math is, again, this is the same math we saw on the original slide. If you have a piece of property for $450,000 that you can sell, I should really increase these numbers one of these days. But if you have something for $450,000 and you have $200,000 in equity in that property, so this is obviously money left over after you pay off the loan, after you pay commissions and title and escrow costs, etc. The IRS wants to see, if you want to pay no tax, the IRS wants to see you reinvest the full $200,000 in equity and use it to purchase new property or properties worth at least $450,000, the same value as the property you sold. You are allowed to deduct commissions and title and escrow costs from that number, so it would be a little less than 450. But generally speaking, those are the rules. Another thing here that I meant to illustrate with these different the different trees in the background here. Here you have something in California as an example. You could go buy something in Wyoming or Missouri or Florida or wherever, which we've been seeing a lot of. A lot of people are kind of moving investment dollars out of California. But just so you're aware of that as well, 1031 is a federal law. It applies, and every which now, as of a very recent law, is going to be recognizing 1031 as well. But anyway, just wanted to point that out. You can go into and out of any of the 50 states. That's totally fine. But anyway, those are the general reinvestment requirements up there. Again, as far as the timeline goes, 1031 has to be set up before the sale closes. This is, again, a standard exchange I'm showing you on the screen here, where you sell first and then you buy second. So it has to be set up while the property is in escrow. And then the actual timeline begins on the closing date of the sale. Again, 45 days to identify the new properties to us, and 180 days in total to actually complete the purchase of any of the properties that were identified on that form. And again, yeah, I forgot about this pop-up. Again, this is, you know, the whole buy-side lead for you guys as real estate agents as well. As another example here, it's just a different property type I wanted to show you. You can see down here, this is professionally managed commercial real estate. Really where this comes into play is if you have a client who is looking to do a 1031 exchange, they have a lot of profit, they have a huge tax bill they're looking at, but they're tired of owning rental property. We see this all the time where they're just like, you know what, I'm going to pay $200,000 or whatever. I'm willing to lose it because I just can't manage this rental property anymore. I'm older, or you know, I have a new job, I moved out of the area, whatever the case may be. They're just tired of managing it. There are solutions for that as well. And that's really what I meant to illustrate here. The reinvestment requirements are still the same. If they want to pay no tax, you still have to reinvest all the equity. You still have to buy property of same or greater value, but you can buy things that you do not have to personally manage. Some of these are professionally managed commercial properties, like, you know, office complexes and apartment buildings. You can buy like small percentage shares in them. Not everyone qualifies. Like, a lot of people sell syndication deals. I'm sure you guys, you know, bump into some of this stuff. Not all of them qualify for 1031. It is kind of a particular couple of title structures that you know, will allow an investor to buy into something like that. But generally speaking, there's like a whole industry built out around solving this problem for people. And so that is a possibility and a good thing for you guys to be aware of too, just to be able to help your clients. And then of course they could also buy something locally or you know, anywhere really. And like if it's a single family property, and just pay to have a property management company take care of it as well. This is a bit more institutional. I mean, you're really At this, with the investments I was referencing before, like owning the percentages of the commercial property, there is zero management on your part going on. I mean, this is like, it's literally like you just get a check in the mail every month. But again, that can be really great for older clients or really anyone who's just kind of tired of managing rental property, but doesn't want to pay the tax and is just looking for predictable income. The timeline is the same. I'm not going to go through this one again, but set it up in escrow, and then 45 days to identify and 180 days to close. The other one I wanted to show you here is a reverse 1031 exchange. This one I don't think I've ever really gone through in a training with you guys before, but these have become more and more common for us. And so I did want to touch on this too, just to make sure that everyone is aware of this as an opportunity for your clients as well. So this is where you're going to be actually buying the new property first and then selling your property or properties second. So it's a regular 1031 exchange. It's just happening in reverse. All the same reinvestment requirements still apply. Same thing. You still want to see you use the 200,000 in equity. They want to see you reinvest. At the end of the day, have the same amount of cash equity in the property that you purchased as you had in your sale. Same thing as a regular exchange, and the same thing with the purchase price. They want to see that you're buying of same or greater value. But as long as you can do that, you can do the reverse exchange. Now, the reason that this is really beneficial to clients, and the reason that I recommend the reverse exchange really when possible, is really because it eliminates that whole 45-day timeline requirement. If you think about it, when you sell a piece of property first, you trigger your tax bill the second that you sell, right? So you're now stuck. The 45-day clock is ticking, and you have to be able to find new property to buy, which can just create a really stressful situation. If you're kind of staring down the barrel of a $150,000 tax bill, you're kind of forced to shop in a rush, and forced to shop under a good bit of pressure. And so the reverse exchange really alleviates all of that. Rather than selling first, you really take as long as you want, make sure you find a property that you really like, and then you close on that new purchase first. And then all you have to do is within the following 180 days, sell your existing property, or there could be multiple properties that is a potential too. But generally speaking, that's how this works. You'll see that the 45-day timeline is really missing from this timeline at the bottom here for the reverse exchange, just because again, it kind of eliminates that whole thing. So it can be a really, really powerful tool, especially in fast moving real estate markets. Obviously, everything is slowed down a bit. But if you have some clients, if the sales, they're thinking it's going to take a while, or if they just find a piece of property that they really like and they have something else that they want to sell, for anybody working with buyers on investment property, this is another great lead generator. If you're working on a purchase with them and you know that they have something that they are considering selling, within the next couple of months, this is a great thing to inform them about. They can get out of the taxes on the sale by setting this up. In this case, it would have to be set up while they're in escrow for the purchase. So again, setting it all up before anything closes. That's kind of the general rule of thumb for no matter what kind of exchange you do. But again, it can be a really, really powerful tool for anybody working with buyers. If you know they own other rental property or any other kind of property that they're thinking of selling, this could be a great tool for them. So we offer free consultations. The same kind of advice I'm giving you now, we really tailor it to the specific investor's situation. We'll go through their exact numbers from their sale. We'll help them calculate the exact tax bill, et cetera. And we use these free consultations, or I should say, you guys can use these free consultations to wow your clients. So I always say, if you have anyone in your past clients or your sphere that owns investment property, you can schedule a consultation with us, and we can go over with them whether they're holding title correctly so that they can take advantage of a 1031 exchange. There are some title structures that really mess people up at the last minute. I can go into those in the Q&A if you guys want to. But learn their options for the future, excite them about listing their property. These are all great things if you're looking for something to reach out to clients about. Same thing if you have a listing lead that's gone cold and you're trying to get them to list. This is just a great kind of benefit to show the client that you're, really looking out for their best interest. We're happy to go through, again, all that exchange stuff with them and see if we can save them some money. And then, as I mentioned before, on the clients who don't want to reinvest, you can offer a consultation with us where, we'll kind of talk them through some of those different options I was mentioning about, that don't involve them actually managing the property on a day-to-day kind of basis. So any of those, in case those are helpful, you're more than welcome to do that. And we're happy to help you guys and try to move your clients along. Again, by bringing up the exchange, just to kind of close the loop, anyone who's seen my presentations before knows that I figured out how to put confetti on the screen. We saved these people from the tax bill, right? And now that's money back in their pocket, money that they can reinvest and kind of keep rolling forward, and then end up, giving to their heirs as an inheritance or whatever. Same thing here. You had a couple looking at $105,000 to $140,000 in taxes. Again, by bringing up the exchange, we've solved this problem for them. And now the money is back in their pocket again. So that's basically it. That's most of the stuff that I wanted to go over. Our new website is plentyfinancial.com. That's what we're going under now. So if you have any questions, feel free to go there and check it out. You can always give us a call too. I think I put our phone number up on the end of the screen here. Something got messed up on this slide. Oh, there we go. I know I have an old picture of the First Team website here. I just didn't get around to updating this. We are accessible through that top tab of the First Team site too. In the services section, I think it still says just sell tax-free or 1031, something like that there if you need to get to us. But that'll bring you to our site and obviously our phone number's there and everything too. This is me, my phone number, the office line here, and my email address. And we'll send a copy of this around too, in case anybody needs our contact. And then Aaron from my office, again, who's listening in here as well, you can reach out to him as well. He's as well versed as I am on talking about these things. But that's basically it. So I will hand it back over to Greg, and I'll let you guys, if anybody has Q&A, I'm happy to answer any questions you have. But thank you for the time.
Okay, and so thank you, Justin, for this presentation. Well done again. There are definitely questions in the chat, and then we'll open it up online too as well. So from Lisa, and I think you covered it pretty well. But is there anything else you can talk about, like for like properties, and what to look out for? The biggest thing is, the question that people have is from commercial to residential, income, and you explained it very well, but is there some other key points you can add?
Yeah, I mean, I would say the key thing to always think about, what the IRS really looks out for is your investment intent, right? That is the number one thing that is qualifying a property for 1031. So as you think about, no matter what the asset class is, no matter if it's single family rentals or multifamily or commercial or, whatever, if the property is being used as an investment, that is what's going to qualify it for 1031. That's the most simple way that I could put it. But just to kind of drill down or to reiterate what I was saying before, in terms of going in and out of those different asset classes, that is totally fine. You can sell a commercial property. You can buy a single family property. You can't buy a single family property you're going to immediately move into yourself. It has to be a rental property. But again, as long as that investment intent is there, and for the IRS, maybe that language is confusing too. I view, and probably all of us view, just buying real estate in general as an investment. What they mean is something used to really generate income. So this is like a property that's actually being rented out. That's kind of the way to think of it. And the same thing goes for Airbnb and, et cetera.
And so with storage facilities, winery resorts.
Oh yeah, absolutely. Those would all qualify. A lot of those I think are commercial property. That's totally fine. I've seen people do it too. Sometimes, on some of the larger residential properties, sometimes people will have an avocado orchard in the back, right? Or oranges or something like that. And they'll actually be able to exchange that back portion, because that back portion is an investment kind of farm thing that they use to grow fruit and sell it. And, that's another way that it could qualify. But yeah, I mean, certainly self-storage things like that. Commercial properties would qualify for sure.
And now, what if their current property is in a trust, right, or an inherited trust, and they want to exchange for another property? Can they do that?
If it's in a trust in general, the answer is yes, they can exchange, no problem. What you said, I think they're also about inheritance, though, that gets a little, well, basically they could exchange it if they wanted to, no problem, no matter what kind of trust really that they own it in, that there's no issue there. The only reason I'm pausing on inheritance is because if they inherit a property, typically the way that inheritance is treated is that you receive the property at the fair market value at the time of inheritance. And so the amount of profit there may not really warrant you doing an exchange. Like, as an example, if I inherited something a month ago and now I want to go and sell it, there's probably not enough profit there because I received it at whatever the fair market value was a month ago, and it hasn't gone up in value really since then. So there's no profit really for me to try to avoid, I'm sorry, no tax for me to try to avoid because I just don't have that much profit. But generally speaking, any kind of trust that you own in, you can exchange for sure.
Okay. And so the next question would be, can you split the equity into two properties?
You can, yes, 2 or 3. That's totally, I mean, really, you can buy as many as you want. The only place you're really limited is by that identification. I touched on that a bit at the beginning, but you're limited to typically 3 properties of any value when you actually submit the identification letter to us. There are ways to identify more, but the IRS starts imposing a lot of rules and restrictions on you if you go above 3. So most clients just stick to 3. That being said, yes, you can certainly invest in 1, 2, 3 different properties. That's totally fine. What they're going to look at is the aggregate value of the they're each worth $500,000. That's totally fine. The total value that you bought is $1 million, and so therefore that would be qualify as satisfying the reinvestment requirement.
Okay, and it's not a single family, but it's a single SFR is being as a rental property, of course. In your 1031, can you buy Jack in the Box?
You can, yes, totally. That's fine. And we have clients do that a lot too. A lot of those Jack in the Box kind of properties, when I mentioned before some of the commercial stuff that doesn't require as much management, Jack in the Box is an example of that, right? Anytime you drive down the road and you see one of those, or a Starbucks, a McDonald's, a CVS, anything like that, those are great things. And I have clients get into those a lot coming out of single family properties that they're tired of managing. Now rather than Sally Jones being their tenant, now they have this big Fortune 500 company that's their tenant. And it's just a whole different relationship. I'm oversimplifying, but I see that a lot.
Okay. And let's see here. I have a seller rental property in Carlsbad. It says here to sell about 1.2 million estimated, and they want to buy in Texas, so they can purchase 2 to 3, properties as we talked about, right?
Totally. We're seeing that all the time. We're in Encinitas, by the way, so we're right next to Carlsbad. But I'm actually I guess the office is in Carlsbad, so it's backyard here. But we see that all the time. A lot of people are moving money into the ones I've seen the most is Texas and Florida. I think everyone kind of got burnt by the eviction moratorium in California when COVID hit, and everyone's trying to go to more landlord friendly states. I'm seeing that a lot.
Yeah. And so now that we're on that subject, can you kind of open up and explain, where are people headed? Where are they putting their money now, since we're on that subject, before we get to the next question,
Yeah. I think, again, a lot of people are moving away from states that are less landlord friendly. I think anybody, especially who's in, any kind of multifamily property, I'm just making the distinction between that versus someone who owns an office building or something. The eviction moratorium wasn't the same for each of those, but kind of across the board, we're seeing a lot of people move things out of California just because of the tax rates and things like that. Also the policies towards landlords. I'm seeing very recently, a lot of kind of unrest and in the commercial community too. just because of they're looking at what Los Angeles did, as I mentioned before, that tax on commercial property over a certain amount, and are kind of scared that different municipalities are going to start doing things like that. For anybody who does work commercial deals, I guess especially in LA, that law does not take effect until I believe April 1st. So there's kind of a push between the next couple of months of like, hey, if you're thinking of selling, get it done. Otherwise, you may be subject to that tax. And also, just to be perfectly clear, since this is such a new thing, I don't know if 1031 would even get you out of that tax. I think it would, most likely it would, but it's such a new law. We have not been able to take a look at it yet. It went into effect within the last couple of weeks. So anyway, if, in case that's helpful to everybody, but I would say those are the two main states I see people going into: Texas and Florida. Idaho's been a big one. Yeah, those are the main ones that come to mind.
Okay. All right. And for those that prefer another language as their preference, do you have accommodators to speak Spanish or any other language?
We have, yes. Aaron speaks much. I speak basic Spanish, but Aaron can speak business Spanish pretty well, who's on the call with me here. So if you have any Spanish speaking clients, he would be a great point of contact.
Okay. And the next question, is there fees on the reverse exchange significantly higher?
They are. They are. Yes, they're significantly higher than the standard exchanges. The real reason for that, it's not us, or any accommodator kind of price gouging clients. It's really just that it's more liability and paperwork for us. The exchange agreement is way, way longer. And primarily, I would say the reason is that we're required to take title to either the property being sold or the one being purchased as the accommodator. So there's extra paperwork there and liability and everything. But yes, those are more expensive.
All right. And is there a limit? How many 1031s you can do in a year?
There is not. You can do as many exchanges as you want. There's no limit.
Okay. So the next question is, can you identify more than one replacement? I know, obviously there's reverse and then there's, the regular, but can you identify though more than one replacement property?
You can, yes. And you should actually, you should identify more than one. The reason I say that is because if let's say you just did identify only one property and now that 45th day passes and you only identified one, remember, you have to buy something on that list. So if that one property craps out for whatever reason during the purchase escrow, if you even got that far, you're kind of out of luck at that point. And the exchange would fail. So identifying some backup properties is a great idea. Also on that point, I should have touched on this before. It's not a requirement, but your goal when you're doing an exchange should be to have that new property under contract and as far the way through escrow as you can be, ideally by the time your sale even closes. And as a second best to that, by the time the 45th day comes around, for the exact reason I mentioned a second ago, you do not want to be in the position where the 45th day comes around, you've identified one or two properties, you don't have either of them under contract, and now you're kind of just crossing your fingers that one of them is going to work out. That scenario, as opposed to having the property under contract, being a significant of the way through escrow, maybe your contingencies are removed at that point. That's a much better position to be in when the 45th day comes around. So not a requirement at all, but definitely best practice if that's possible.
Okay. And then some have questions in regards to, is it 3 property limit? Is there any exceptions to anything in regards to nominating something?
There are, yeah. So if you're going to go above 3 properties, the rule that comes into play there is called the 200% rule. And this is what I was saying before, that they start imposing other rules on you when you go above 3. If you go to identify 4 or 5 or 6 different properties, the total value of the 4 or 5 or 6 cannot exceed 200% or double the value of the property that you sold. So as an example, if you sell $1 million property and you want to identify 4 or 5 or 6 new properties, the total value of the 4 or 5 or 6 cannot exceed $2 million, 200% or double the $1 million value of the property that you sold.
All right. And then, So if they don't invest all of their equity into the new property, they take some cash out, then it's obviously they're going to be taxed on the remainder, correct?
Right. So that's fine too. That's called a partial exchange. All the examples I gave are if they, if the client wants to end up paying no tax at all. But certainly, yeah, if they bought something of slightly lesser value, that's still a potential as well. And it's still going to be really helpful to them. They're still going to avoid a lot of taxes. But yes, they would just pay taxes on the difference there. If they sold for $1 million and only bought something for $900,000, they're going to pay taxes on the $100,000 difference there. Which is still probably significantly less than the total amount that they could be paying it on.
Okay. And then, so someone's in escrow for, say, the sale of their investment property they have right now as a 1031 exchange. And before it closes, they identify another property. They place their own funds as an earnest money deposit. How is that earnest money deposit treated?
That's perfectly fine. When it comes time to actually close on the purchase of the new property, escrow can write that in on the closing statement, write in that they would like a reimbursement of the deposit. And so that way, when the client actually requests the money that we'll be holding from their sale, we'll send it out to escrow, and escrow at closing can reimburse the client using those exchange funds. They just have to list it on the closing statement, but that's totally fine. There's no tax consequence to doing that.
Okay. And then, so we talked about the 200% rule. What about more clarification on the 95% rule?
The 95% rule is the final frontier. And I never bring it up because to be honest, I find it so ridiculous that it's just like never comes into play. What it is if the initial 3 property rule is surpassed, and then which has no limit to the amount you can, the dollar value you can identify, then you go into the 200% rule zone. And that's, what I explained before. You can, the total value can't exceed 200% or double the value of what you sold. And if that is exceeded, then you're on the final frontier of the 95% rule, which states that if you identify 8 properties, let's say, you have to close on 95% of them or your exchange will fail, which effectively is the IRS saying you need to close on all of them. Otherwise, the exchange will fail. And so that's really the reason I never bring it up, is because it's just a difficult thing to do. It kind of, the benefit that you get from identifying more properties kind of drops off after the 200% rule, because otherwise you're kind of you're damning yourself to have to buy all 8 in that example.
All right. And so if you do a 1031 exchange, successfully purchase that property, a family member chooses to rent, is that completely fine, right?
As long as you are renting to them at a fair market rate, that's fine. If it's $3,000 a month to rent an apartment or something, they don't want to see you renting it to them for $50 a month. Like that they would red flag. But as long as it's within the realm of the $3,000 a month, it could be a little higher, a little lower. That's totally fine. Yeah, and you can rent to a family member.
Okay, so if you mentioned inheritance is a market value. So just to clarify, if they inherited a duplex rental worth about $2 million and they want to exchange it with a commercial space, then they would not need a 1031 exchange?
The answer is it depends. And this is where we have difficulty, just as an outside party who has not been filing this client's tax returns. We're going to have a difficult time estimating what that tax bill would be. We can probably get in the ballpark, but it's at that point, the client needs to check with their CPA and see if they have any profit there, and how much that profit is, how much the tax would be, et cetera. It really just depends on when that property was inherited. If someone inherited something 10 years ago, then yes, they would definitely still need the exchange today because the property's gone up in value so much in the last 10 years. But if they inherited something yesterday and they're selling it today, it has not gone up in value at all in the last 24 hours. So no, they probably wouldn't need it. But the safest answer there is it depends, and the client should check with their CPA and figure out exactly how much profit and tax that they have. Okay.
The next question is, can I sell 2 or 3 and buy 1 property?
You can. The answer is yes. It gets a little tricky just because if you're trying to sell multiple properties of yours and consolidate them into one new purchase, every different sale of yours is its own 1031 exchange. And therefore, each one has its own timeline that you have to adhere to, its own 45-day and 180-day timeline. So it's totally possible to do what you're envisioning. It's just that you're going to have to, the way to think of it in that example, you're going to have to follow the timeline of the first property that you sell, because you need to complete the purchase of this one new property within the 180 days of the first property that you sell. So you'll also, in that 180 days, have to sell your other two properties, and then you'd be able to purchase the new one. So it's possible. It's just you have to be careful of the timeline.
Right, Justin. Thank you for being so thorough. So now that the chat, there's one more that just came through the chat.
Okay.
What is the role of the realtor in a 1031 exchange? Are we communicating to the exchange company directly, or is escrow working directly with the exchange, for those that don't know?
So primarily we work with escrow. It's a 1031 there's a lot of like paperwork kind of stuff involved. And that's primarily handled through escrow. So that's the main person that we'll correspond with. The real estate agent we love to keep in the loop though. Just so you're clear on the timeline and everything as well. We get a lot of introductions to clients from the real estate agents. And a lot of times they'll join in for our initial phone call with the client. And that way, everyone's on the same page for the whole transaction. But then once escrow is open, primarily we're dealing with escrow rather than the agent.
Great, thank you. Now let's open it up to any questions in regard, and just for those of you that haven't put in the chat, just want to open up to have any questions for Justin at this time. Okay, Marcella. No, you raised your hand, Marcella. You have a question for Justin? Okay. Asked to unmute. Anybody else have any questions for Justin?
Yeah, and Marcella, if you can't, if the unmute thing is not working,
I'm sorry.
Oh.
I couldn't.
Oh yeah, no worries.
No, I'm fine. I have a question. How much it will cost to do the 1031 exchange?
A standard exchange is typically $1,195, so it's just under $1,200, and that's it. And then a reverse exchange, or as we said before, those are a lot more expensive. Those are $5,995, so just under $6,000. But those are the two main prices that you'd be looking at. Yeah.
Okay, thank you.
Mm-hmm.
Another question came up is and I hopefully understand this, the right is, can you refinance and cash out with a 1031? And I'm thinking, is it once you do a 1031? Can you tell us more?
Yes. And good thinking to whoever had that question. That is wise. And you're correct. Yes. So when you have refinance proceeds come to you, like from putting a loan on a property, that is not taxable. And so refinancing is possible with an exchange. You just have to wait, as you said, Greg, until the exchange is over. So you would sell your property, buy the new one. And then once that transaction has closed, hypothetically, you could go out the next day and refinance the cash out of that property. And there's no tax consequence to doing that. It's a great tool.
Outstanding.
Yeah.
All right. Any other questions for Justin? All right. So from Marcy, we've got, when calculating the profit amount of the investment property, do they take into account the improvement expenses incurred?
They do if they are capital improvements to the property that, like if you replaced a roof, or you redid a kitchen, right? Anything that's going to be affixed to the property, that all is considered when calculating the profit. So that would be added to your tax basis, and that would therefore decrease the amount of profit that you have. Because it's an allowable expense. The things that they aren't going to count are like if you're putting in like a new rug, or like kind of cosmetic kind of stuff to the property that's not affixed to it. But anything that's affixed to it, yes, that would affect it. The client would also have to make sure that they had been reporting those expenses to their CPA who's filing, or whoever's filing their taxes, just to make sure that they're documented properly. But yes, that definitely factors into the profit calculation.
Outstanding. Right. Any other questions? All right, Justin. Yeah, you've done a thorough job. I mean, you already got some in the chat that says thank you so much. Very thorough. We really appreciate you, Justin. Doing this. I know you've done it several times for our company. You're always very thorough, and there's nothing but good things said about you, Justin.
Yeah, well, thank you. Yeah, and I really appreciate the opportunity. Everybody, and we love working with you guys. So I get excited when I drive around and see the first team signs. So thank you for having me. And let me know, like I said, my contact information's up here. Greg, I can get you a copy of the presentation if you want to mail that around to everybody with mine and Aaron's.
That would be absolutely outstanding, because what we'll do is we will upload this. In the first place, we will go ahead and then attach the slideshow too as well for everyone.
Okay, awesome. Okay.
And so besides being here today, we always announce what's going on next week. So next week, we're already in December. Oh my goodness. We're going into December, and there's only going to be 2. So we have 2 weekly Wednesday trainings because due to the holidays later on. So we're going to do the first 2 weeks on Wednesday. So the first week is going to be effective follow-up. And that's going to be on Wednesday. And then the second week into December, we will have the Bradford Exchange, the tax exchange. So we're going to help you out in regards to what you can write off as, realtors and your taxes and what to look for moving forward, too as well. We appreciate you being part of First Team. We appreciate you being part of today. Thank you, everyone, for joining. Thank you, Justin, again. All right. And I look forward to receiving that from you.
Thank you, you guys.
All right. Take care, everybody.
Yes, great training.
All right. Bye-bye.
Thank you.
Thank you.